Hi, Dominique, and welcome to another edition of The Week Ahead. Hope you're well. Let's dive right in. I think, as we said last week, it definitely seems like markets are a bit more quiet, and then for most of the times that we've done this every week last year. So let's start off with, I guess, continuing the market's interpretation of the economic activity in the U.S. and also kind of the Fed's reaction so far, and then we can obviously kind of then focus on the week ahead.
Sure. So the Fed was on its pre-meeting blackout, but I don't think the data would have changed their decision in any way. I think the markets interpreted the data as showing that the economy is cooling, whether it's the GDP or the PCE for December, and I continue to disagree. We got poor consumption for December in real term, but I think this reflects largely seasonality, and also there was a big decline in purchases of new cars, which you don't see in other indicators like world car sales, for instance, which again makes me think that the data is a little dodgy. And on the, well, I mean, it's not the first time for this time of year. And on the GDP,
COVID,
people rightly commented that final sales that exclude inventories, external trade were lower than the headline. The headline was 2.9%. Final sales was only 0.8%. So smaller, but this is basically a payback for the previous quarters where the GDP was below final.
Sorry, I think we got cut off. Sorry, can you say that again? We got cut off.
Sure. So I was just explaining that the positive gap between GDP and final sale was a payback for a negative gap beforehand. GDP is more volatile than final sales, and so I'm not as negative as the market. I hope our listeners have a chance to look at my review of the GDP, where I go through the main components and I make my case.
Quick one, core PCE, isn't like that the big thing the Fed looks at? I guess, and I've asked this in the past, why does the market seem fairly in line, I guess, and continuing to show relatively that it's cooling? Is that true? And is that, I guess, why does the market focus more on CPI than that? And what is your kind of confirming your interpretation of the core PCE data that came out?
So core PCE, what we had,
core PCE.
Yeah, we had continued deflation of goods prices, continued acceleration in shelter cost inflation, and non-shelter core services moving sideways to slightly declining. And so nothing new there, nothing new relative to the CPI. The Fed prefers the PCE because the PCE takes into account the fact that when prices go down, people can substitute and buy cheaper things, which the CPI does not. No, I mean, my view continues to be that the deflation in energy prices is pulling down core CPI and PCE, especially goods. So to me, no news there.
Right. So just reiterate for people who don't listen to this every week or read your stuff every week, and they see or know your 7 or 8% call, your view is that's not going to happen in the next like 3 or 4 months. In fact, you're pretty much in line with this kind of 25 next 2 meetings and also the data not like massively surprising that it, at least for now. And then in the next kind of 3 or 4.
And who?
Yeah, I was saying that then the point of kind of lower energy prices helping will kind of play itself out, and then by the summer the Fed will have to start hiking again. Certainly, as opposed to certainly not cutting, but your view is by fall they'll most likely having to be hiking once again, as it looks like it's definitely not getting below down to 2%.
Well, yeah, I mean, so maybe this is a good segue into the Fed next week.
Yes, big one.
So basically, I agree with 25 basis points. So there's been some noises about the Fed doing 50 because they are not happy with the easing of financial conditions, and I strongly disagree. For the Fed, so first of all, the Fed doesn't like to shock the market. And second, there is not enough of the consensus within the Fed on the basis of the current data, which I expect to remain, soft on inflation, strong on growth for a few months, as you just explained.
Yep,
so
exactly.
That is not enough to give the hawks enough sway to push for 50 basis points. So I strongly disagree with that. I think it's 25. And the questions are going to be, of course, about, when is the Fed going to cut? Because in terms of end 2023, Fed and markets are about 70 basis points apart. And I expect that, first of all, Chair Powell is going to say, you can't look at just a few data points to be confident that inflation is headed down. And second, I think the frame of reference is going to be the SCP, the December SCP. And what the December SCP shows is the FOMC expect core to slow down to 3.5% at the end of the year. So I expect that Powell could say something along the line, if inflation is much lower than we expect, and we are confident that the trend is going to continue, then we could change policy. I think he's also going to say, if inflation is higher than we expect, we will not hesitate to do 50 basis points and, raise the trajectory of the Fed funds rate. But at this stage, I think he has zero credibility. So he can do all the hawkish threats he wants. I don't expect he's going to bridge to get the market to move closer to the end 2023 Fed funds rate that is in the SCP, so 5.1%.
Sorry, can you just say the last part again? Yeah.
So I think that, Powell is going to be like the proverbial two-handed economist. If inflation is lower and it's sustainable, we will consider changing policy, but we will need a lot of data points to do that. Waller said after the summer, let's see where we are. That's the left hand. The right hand is a hawkish hand. And I'm sure Powell is also going to say, but if inflation is higher than we expect, we will not hesitate to tighten policy further. And I think the hawkish hand will be completely ignored by the markets.
Right. So in general, do you see, because obviously post a lot of these, certainly the speech after the questions or presser, we've seen some big moves in the markets after that and the follow on 1 or 2 days. Do you see any chance of that happening again this week?
I doubt it. Essentially, the data is ambiguous. As I explained, we have strong growth, slowing inflation. So something for the hawks, something for the doves, in order for the market to move, or in order and for the FOMC to change its stance, we need either growth to go down or inflation to go up. And we're not going to get that until the middle of the year.
To the middle, yeah. I think one of the things that seems to be permeating throughout a lot of markets, particularly kind of equities and I would say FX too, but I was going to say equities and interest and bonds, or fixed income, is basically volatility coming down. Because right now it does seem we have kind of contrasting between growth and inflation, and the net is we're kind of like in this in-between area. Some people are calling it like a Goldilocks, so we shall see. But and a lot of people have bought a lot of volatility protection in a myriad of assets this to start the year, and that's probably continuing to get unwound. Okay, so outside of the Fed next week, thank you for that. Well, what do you see as the key pieces of data, and are you out of consensus on any of this stuff? And do you see any of these being a big market moving?
Not really. I'm close to the consensus, but frankly, I think people are focusing on the wrong things. Like, for instance, a consensus on the headline payroll, 188,000 from 223. So for sure, we'll have a slowdown because we are getting back to trends from precedently of super high NFP. But honestly, that's not what matters. What matters much more, I think, at the moment, is the whole nexus of hours worked, overtime, temporary employment, and involuntary part-time workers. So basically, the hawks are saying that the decline in hours worked, overtime, and temporary employment all signals that labor demand is weakening. And I'm saying it's not correct. It signals that the labor market is normalizing because we are also having a decline in the number of people who are involuntarily employed part-time. In economic jargon, it's called part-time for economic reasons. And what this means is that firms are hiring more full-time workers, which is why all these things, hours worked, overtime, temporary services, which were during the pandemic well above pre-pandemic levels because people couldn't find workers. So now that firms have been able to find workers, they don't need all this, and it's coming down. So it's normalization, because firms wouldn't be hiring more full-time workers if they didn't have more confidence in the economy.
Right. So you're not seeing that as a sign, like the market, that businesses are still, they're growing, but they're unsure. You're saying those numbers coming down, they're just coming back to what's normal or trend. And
I'm not seeing this as a sign of weakening, because what I am seeing is the proportion of workers who are part-time for economic reasons. So part-time because they cannot find full-time work, that proportion is going down. So what it means is that firms, the data is showing that firms are hiring more full-time workers, which is a sign of labor market strength. Yeah. So that's what I will be focusing on. Right.
What do you think about this thing that somebody I was reading talking about in the housing and construction market, which is obviously a lot of jobs in America. Development companies or construction companies are hoarding employees, even though business is slowing for whatever reason, because they see it picking up and they think this is a short-term thing, and they're afraid if they let too many workers go, they'll just find other jobs and it'll be very expensive to rehire. And that's one reason why we're not seeing the, say, negative payroll numbers where some people had been expecting.
Well, that's probably part of the whole story, but not the whole story. I mean, and we're not talking even of negative. I mean, if people were expecting negative payroll numbers at this stage, those people are deeply wrong, because we're still at twice the increase in labor supply, 200,000 a month. So, and that has been the difficulties in this recovery. We have a recovery not from a contraction, but from an enormous, unsustainable expansion. So we are normalizing, but from up, if you will.
But from a high level,
yeah.
And just on that, on payrolls, like, what data would you say, or numbers you would say, like, oh, maybe I am wrong? Or, I mean, obviously you're going to be like Powell, you're going to say, well, one or two numbers is not going to get me to change my view if I fundamentally think most signs are pointing to something. But is there next week or any week? Obviously, next week has a lot of pretty important data points.
So the two ways I could be wrong is either if we have a negative demand shock, like say, for instance, the government implements a huge contraction in expenditures,
Right.
which I think is not likely, or say household panic, and suddenly there is a huge increase in their savings rate. So that certainly would falsify my view. The other way in which I could be wrong is if, say, we have another decline in energy prices. Say, oil goes to $40 a barrel. Then that would help bring down inflation expectations, both of workers and businesses. And also there would be a transfer to businesses that use oil, and they would be able to give higher wages or to their workers while maintaining their margins, or workers' demand for higher wages would soften because of this decline in energy prices. So these, I think, are the key ways in which my view could be falsified.
Okay, what other data? I see like the employment cost index. Is that a big one? You said you're looking for a negative surprise.
Yeah, it's not a big one. I mean, so I've been complaining about the JOLTS being meaningless because the number of actual hires relative to the number of opening is very low.
Yeah,
and that ratio has been quite stable. But there is other data in the JOLTS that I think is also important, which is quit rate and layoff rates. And quit rates are above the pandemic. So people feel still super confident about the labor market so that they can quit their job. So it's coming down, but it remains above pre-pandemic.
so that's a good one to look out for. Okay.
And then, yeah, the layoff rate is the same story. It's below pre-pandemic. But for once, actually, I'm going to pay attention to data on the residential real estate market that usually I always say, oh, residential investment is 3.5% of GDP. I mean, still, residential investment detracted 1.3% from GDP growth, because it's been, even though it's only 3% of GDP, it's been contracting at 35%,
Yeah.
quarter on quarter annualized. But what was interesting in that data is that the contraction was the same as in Q3. So in other words, the second derivative was zero. So the rate of decline was no longer increasing. And I've noticed something similar with residential construction spending. It's starting to stabilize. We saw that in November, and I'll be looking for further stabilization in December, because one of the points I made in my GDP review is that residential investment is actually 10% in real terms, and relative to the number of households, it's already 10% below pre-pandemic levels. And before the pandemic, you didn't have overinvestment as you did before the GFC. In fact, if you look at vacancy rates for both rental and owned apartments, they're still at historical low. I mean, close to the low of 50 over a 50-year period. So this is a case of the Fed with its crazy pandemic easing, just putting the residential market on steroid. And
Right.
now that the Fed has removed this absurdly high easing, the market is actually adjusting fast, adjusting perhaps more through prices than through investment. But since there was no excess investment before the Fed, in effect, pumped up a bubble, the resolution of the bubble could be actually quite fast.
Anything else? I guess we have like PMIs.
The PMIs, and then we have the consumer confidence from the conference board.
Right.
But as you know,
ISM,
the soft data has become so decoupled from the hard data. In other words, the noise to signal ratio has become really unfavorable. So I will certainly be on the chat and commenting, but it's not my main focus for the week.
Yeah, so I'll just do a quick summary of the pieces. Let's start on Pro. So certainly for any of our Pro clients who hadn't seen a few super cool pieces we put out this past week, Bilal's macroscope that came out on Friday, calling it the Year of Asia, I guess on kind of a take from the Chinese New Year, and a lot of that driven by outperformance on growth led by China, but obviously positively impacting the whole region. I did see that it was interesting that Europe grew at 3.5% last year, considering like if you looked at Twitter or listened to most of the other research houses, certainly in the more retail focused, they would have told you Europe was in the worst recession in hundreds of years, but in fact they weren't. Rates Weekly, where Henry and Bilal dive into the continuing rationale for the BOJ to abandon YCC. So not really, that's a trade to manage, but definitely not a trade to give up on, is our view. And then Delvier released a very interesting kind of new publication looking at FX volatility. And I guess there's 5 different ways to measure FX volatility. This is beyond just kind of close to close, and helps better understand where the risk premium is for different currencies and by different volatility approaches. And then for Prime, so for people listening to this who have come across our YouTube or Twitter or something like that, please check out our pieces on Prime. John Tierney goes from, which has been a fantastic call, long exposure in his asset allocation for equities in industrials and materials, and now actually flipping that to shorting those markets and those themes. Delvier talks about Bitcoin and helps explain why Bitcoin has gotten off to its best start in 10 years, which is pretty amazing. Obviously, we had a sell-off in December, but definitely picking up in sentiment towards crypto. And Richard Jones had a very interesting take on should we call climate issues climate change, or should we really think better about things, assessing stuff in risk kind of mindset? So in many cases, mitigating climate risk or climate potential impact. So this is really thinking about things in risk terms and climate, which seems to be a growing view in kind of how to deal with things, certainly in the short term, but potentially in the long term as well. And yeah, this has been great. Dominique, I don't know if you have any last words. Hopefully you can hear me.
So no, I mean, just to thank people for listening to us, and see you all on Slack, on Bloomberg this week, and good luck as always.
Okay, awesome. Thanks, and have a very nice weekend.